So moving into the last month of 2024, we're now seeing green pretty much across the board for real estate prices in Canada, with provinces like Alberta and Quebec leading the pack with double-digit year-over-year growth figures, which is pretty crazy to see unfolding right on cue as I'd been predicting for the past 12 months. And when zooming out over the past 2 years, we're seeing upwards movement both in total transactions and average sold price across the country. So what's going on in the Canadian real estate market, and will further interest rate cuts by the Bank of Canada continue to push property prices upwards? Let's talk about it in today's video. So on October 23rd, the Bank of Canada made its largest rate cut in recent history, shaving off 0.5 basis points from the key interest rate, which brought the rate down from 4.25% to 3.75%, which is now 1.25% down from the 5% rate that we experienced from June 23 to June of 2024. And in parallel to this, the next interest rate announcement is set to take place on December 11th, at which point I'd expect to see another rate cut of probably 0.25% based on current economic and inflation trends, although that's still to be confirmed. Regardless though, the general idea here is that the Bank of Canada is now feeling quite comfortable with cutting interest rates that had been raised in the face of rampant inflation following the pandemic's repercussions to alleviate the issue, which for the most part it has. That being said, I wouldn't expect to see interest rates bottom out anywhere near what we experienced in 2020 through to 2022, as I'd expect further gradual 0.25% rate cuts over the next year or so, landing us in the waters of stabilized 2 to 3% interest rates moving forward. Now, although lower interest rates do tend to promote a high degree of consumer spending and tends to also stimulate borrowing for vehicles and houses, there isn't a direct one-to-one correlation though between interest rates and property prices, as specific market dynamics as well as other factors also play into the equation, of course. But yes, dropping rates most certainly is the leading cause for heating up the real estate market across the country right now, as many of these sideline buyers over the past 3 to 4 years are still very much eager to buy their first property, right? It wasn't long ago that we were looking over data from a poll about how much of a rate cut would be needed for buyers to jump back into the market, which indicated that the rate cuts we're experiencing right now would actually be ample to get many people back into the market. And of course, yes, it's easy for people months ago to say that at a certain rate cut, they'd be jumping back into the market, and that yes, the goalpost always tends to change over time, with more recent data suggesting that 74% of Canadians want to see interest rates below 3% before willing to buy. But I think that's wishful thinking, honestly, and that by the time we get to 3% rates, transaction volume and property prices will have ample time to really heat up again, potentially pricing out those buyers waiting for better rates. It's really a cat and mouse game. And that's really unfortunate, because Canadians are in this catch-22 where waiting for lower rates will be met with higher prices. And so if I were to be in the market right now, I'd try to buy something in my price range, but on a 1 to 2 year term, where I'd refinance after said term at a lower rate, hopefully, before prices get out of hand again. So let's actually talk about that. Is it really possible for prices to continue to rise in Canada? We can get real technical about the reasons why the Canadian housing market has gotten out of control over the past 5 years, but ultimately it comes down to supply and demand for housing units, period. In Canada, we simply do not have enough housing starts to accommodate for the demand that's been increasing and built up since the pandemic, mainly due to the rampant increase in population that's been concentrated in metropolitan areas. Vancouver, Toronto, Ottawa, Montreal, Calgary, these are the markets that the largest population growth has been experienced. And this has both impacted property prices, but also rent prices, of course, as many newcomers to the country start off by renting, which is completely normal. Now, I know that this is a controversial topic and that some some may disagree with the idea of what I'm saying, but you can't disagree with facts. More people in a market and who are looking to buy a product with limited supply means the values go up. This is just the basis of supply and demand for commodities. So although there was a dip in transaction volume and property price points during the period of higher interest rates, as of course less people were able to qualify for the mortgages needed to buy said homes, well, what we're seeing now is a resurgence in transaction volume because with lower rates, people are able to qualify once again despite prices being higher. They're able to qualify for that monthly payment even though they're taking on an asset that's value is much higher. So over the past couple of weeks, it was announced that immigration numbers would start being limited as of 2025. Why this wasn't done sooner is anyone's guess, but we're looking at target values now of 395K in 2025, drop down to 380K in 2026, and then 365K in 2027. And realistically, regardless of slowing population growth, though, long-term damages have already been made for the next 5 to 10 years in Canada's housing market. Even with a change in government in 2025, if that is what ends up happening, which I'm pretty sure it will at this point, well, the number of housing starts isn't going to just miraculously change from one year to the next to bring back any level of affordability for the average Canadian family. Let's remember that to bring affordability levels back down to reasonable levels, the CMHC estimated in 2022 that we'd need to see 3.5 million new housing units by 2030. And that figure is above the amount of units that would be built anyways in a status quo environment, bringing up the total amount to 22 million units needed by 2030, and that was in 2022. But more recently, this has been revised to account for slower economic growth in the country than what had been considered in that 2022 report under two scenarios. The CMHC's high population growth scenario examines what will happen to the housing supply gap if current immigration trends continue to 2030. And in short, they find that the gap would increase from 3.5 million units needed to 4 million housing units needed. And this is because the higher population, of course, and larger pool of income that it brings with increased demand for housing. In contrast to this, under their lower economic growth scenario, looks at what would happen if economic growth is weaker than in their baseline scenario and current immigration policies were to end in 2025 with a change of government, which I think they would under the conservative government. Well, they believe that the housing supply gap would fall to 3.1 million units needed. The bottom line, though, is that regardless of what happens in politics and regardless of immigration values through to 2030, there will continue to be a shortage of housing, smaller or larger may it be, which I believe will keep values on the higher end and even growing, even if we do only see lower single-digit year-over-year growth values, more typical of a healthy real estate value growth. Additionally, despite them already becoming out of reach for millions, single-family homes in major urban areas will only continue to become even more out of reach in Canada, becoming these commodities that are passed down to the next generation or that can only be bought by high-income earners. Why do I say this? Well, it's because the only thing that gets built now in Canada are multifamily properties, as they're what the market has commanded over the past couple of years with this fast-growing population. Don't believe me? Just take a look at this data from the CMHC between January and October of 2024. We can see very clearly that across Canada, there have been 36,353 housing starts for single-family detached houses versus 152,000 for all other types, mainly being multifamily properties, because this is simply what's most profitable for developers. So essentially, this means that year to date, only 23% of new housing starts are single-family homes across Canada. And more often than not, these are homes that people are buying land for and getting contracted for a custom home, more than these large developments that are a thing of the past. Long gone are the days of a developer buying up a large piece of land, dividing it up, and then building, say, 1,200 square foot homes. Instead, Instead, what's now more viable in the face of our country's challenges is building a 150 unit building on that same plot of land. It's really kind of sad and soulless and leads to developments that look like this one down the street from my house. Hey, a quick break here to speak about today's video sponsor, Moomoo. So I think it's safe to say you've all seen that the Bank of Canada recently announced its fourth interest rate cut since the summer, now lowering the benchmark rate from 4.25% to 3.75%, which means that the interest rate that we'll be earning on the cash deposits that we leave in our high interest savings accounts will likely follow suit with many institutions. But if you want to take advantage of a platform that'll allow you to earn a higher interest rate, I'd suggest you check out Moomoo, which I've been using for a while now as a stock investment platform that also offers a 6% interest rate on your cash deposits while it's sitting in your account waiting to get invested for a limited period of time. The key thing with Moomoo's interest rate offering is that the interest rate accrues daily, so it's easy to deposit and withdraw funds whenever you please while still earning a return for the days where your money's been in your account. Additionally, the platform makes it really convenient to quickly identify stocks that are closely related to and potentially impacted by an interest rate cut in the first place with just a simple search. For example, when you open the app, you can immediately view a comprehensive chart for the theme of interest rate cuts in Canada. You'll also see the performance of related stocks and how they're performing. You can also explore the constituent stocks, apply filters, and sort them based on earnings to identify those with greater investment potential, which allows you to assess whether there are viable opportunities among stocks influenced by interest rate cut policies. And whether you want to invest in Canadian or US stocks and ETFs, you can easily find positions that benefit from interest rate cuts in these two different markets, where with Moomoo, its robust risk control features makes investing just more secure. For instance, you can buy an asset and set a conditional stop loss order where this feature doesn't limit your potential gains. Instead, it automatically adjusts the stop loss line as the stock price rises. And in addition to offering low stock and ETF transaction costs, Moomoo provides some really great incentives for new users. So when you sign up, you'll receive $2,000 in commission-free trades. And if you also deposit $2,000 into your account, you'll get a $200 stock cash coupon plus up to $2,300 in cash coupons or an Apple gift card when you transfer your positions to Moomoo from a different institution. Trust me, this is one of the best welcome offers available in Canada, so make sure to sign up for Moomoo using my link down below in the video's description. It's totally free to do, and with that said, let's talk about my stock returns over the past 5 years. All right, now from here, considering the amount of mortgage renewals that we're set to see over the next 12 to 18 months, I know a lot of people have been weary of whether or not we could see larger defaults leading to higher supply in the market, thus maybe bringing down property values. And this is a valid questioning for sure. Let's take a look at the numbers. These values are reported by the CMHC and gives us information on delinquencies and various types of credit, including HELOCs and mortgages, where we can see that as of Q2 of 2024, delinquencies reached 0.19%, which actually remains below the average seen since 1990. Now, of course, if delinquencies are to happen, it'll be now through to 2026, as 85% of these mortgages were taken out when the Bank of Canada's rate was at 1%. But I'm skeptical as to whether or not we'll truly see large-scale defaults. Yes, I think we'll see a small uptick in defaults for sure, but enough to truly make an impact in the housing market? I don't really think so, as we're continuing to see rates decline backed by the Bank of Canada and the government over the next 12 months. And it's in people's best interest to do everything they can to hold on to those monthly payments rather than lose their shirt and lose their house. Realistically, despite what the government may say about wanting to help new homeowners, there's just no way the Canadian government will allow for the real estate market to truly crash in Canada, as there's way too much at stake in the value of Canada's housing stock and what that represents for the retirement of millions of Canadians. So I've said it before, but the number one best thing that you can do if you're looking to buy over the next year or so would be to move out of large metro areas if you're able to, and to focus on areas with lower cost of living, stable job opportunities, and growing communities. This shift can not only, yes, save you money in the short term, but also provide a better quality of life and potentially a better longer term investment opportunity as those regions develop. So what do you think though? Are my takes on the housing market accurate, or do you think there are other factors at play here? Make sure to let me know down in the comments. And if you enjoyed today's video, you know what to do. Drop a like and subscribe to the channel for more Canadian real estate as well as personal finance videos. Also, don't forget to sign up for Moomoo to get those bonuses. And if, by the way, you're interested in learning more about how to invest in the stock market, I'd recommend you check out my totally free course over on Skillshare. You can find a link down below in the description. It has over 3,000 students now, which is crazy to believe. 7.5 hours of content that you can watch at your own pace. Link to that course down below in the description. So with that said, thanks a lot for watching, and I'll see you in the next one.